Welcome to the Asian Connection Mortgage Podcast, where we connect Asian Canadians together to talk about anything related to real estate, mortgages, and finances, based out of Vancouver. Our host is John Lee, mortgage broker with Arise Mortgage. Grab a bubble tea and enjoy the episode.
What's up, everyone, and welcome to another episode of the Asian Connection Mortgage Podcast. I'm John Lee, mortgage broker and financial advisor located in Metro Vancouver in BC, Canada. So lately, I've been talking to a lot of clients who are feeling the increase in prices. So inflation is still making things really expensive, and the cost of everyday living just keeps going up and up. So for many people, their largest monthly payment is their mortgage. And when that payment feels too high, it causes a lot of stress. So clients are reaching out asking, well, how can I lower my mortgage payment? They're looking for ways to get some breathing room in their budget. And today we're going to talk about one strategy that can help, and that is, drum roll, refinancing your mortgage. Specifically, how you can refinance to reduce your monthly payment, even when you might have to break your current mortgage contract. So many of you might be in a similar situation to the clients I've been speaking with. A few years ago, when you last renewed or took out a new mortgage, rates were much higher. Many people locked in at rates above 5.5%. Now, fast forward to today, 2026, rates have come down. We're seeing rates in the low 4% or so in many cases, and that's a pretty significant drop. So if you're paying, say, 5.75% on a $1 million mortgage, and you could refinance to get a rate of 4.09%, that difference can make a big impact on your monthly payment. But here's the catch. You're probably still in the middle of your mortgage term, and breaking that contract early usually means paying a penalty. So the strategy we're using is to break the current mortgage term, secure a new rate at that lower rate, and more importantly, extend the amortization period back to 30 years. Let me give you an example. I recently worked with a client who had a $1 million mortgage with about 22 years left on the amortization, and they were paying 5.75%. Their monthly payment was substantial, and I helped refinance them into a new mortgage at 4.09% and extended their amortization back to 30 years. So, what happened at the end? We were able to free up around $900 per month in their cash flow. Can you imagine how much relief that provides when you're feeling squeezed by everyday expenses? So that client felt so much better just knowing they had that extra money each month. Now, the obvious question is, does this actually make financial sense? You're paying a penalty to break the old mortgage, and you're ending up with a larger mortgage balance because of that penalty and potentially getting more cash out. But here's why it can still work out favorably for your monthly budget. The key is understanding how the numbers play out, especially with the penalty. When you break your mortgage early, there's a penalty. This penalty is usually added directly to your new mortgage amount, so you don't need to pay anything upfront. Your new mortgage becomes a little bit larger than what your old one was. However, even with that larger mortgage balance, the combination of two factors can lead to a better cash flow. So, number one is the lower interest rate. You're swapping a higher rate for a significantly lower one, and this immediately reduces the interest portion of your payments. And number two is the extended amortization. So, by stretching the mortgage back out to 30 years, you spread that lower interest payment over a longer period, which dramatically lowers the required monthly payment. So yes, the client ends up with a larger mortgage balance than they had before the refinance. And yes, they are effectively paying that penalty over time through their new mortgage. But the immediate relief of having an $800 lower monthly payment can be invaluable. They're essentially paying a little extra over the long term to have significantly better cash flow today. And this is a trade off many clients find very worthwhile when they need immediate relief. Now, Does this strategy make sense for everyone? No, not necessarily. And it depends on a few things. Number one is the penalty amount. So, how much is the penalty to break your current mortgage? A very, very large penalty might make the numbers harder to justify. Number two is the rate difference. So, the strategy works best when the new rate is significantly lower than your current rate. And what are your goals? Is your goal primarily to get immediate cash flow relief, or is it to pay off the mortgage as fast as possible? This strategy prioritizes only cash flow. Anything else, it doesn't really make sense because you're going to be paying more. And lastly is your home ownership plan. So are you planning to sell your home in the next year or two? We also have to factor that in as well. So it's crucial to run the specific numbers to your situation. And we usually compare your current mortgage details. So looking into your mortgage balance, rate, amortization, and penalty against what a new mortgage will look like. And from there, we look at the total interest paid over the life of the new mortgage versus staying where you're at and status quo. So this move isn't about getting something for free. It's about making a calculated financial decision to improve your current cash flow by leveraging today's lower rates and extending your repayment period. For many clients, feeling the pressure of rising costs, it's a very effective solution. So if you're finding your mortgage payment a struggle right now, and you're seeing that interest rates have dropped since you last locked in, it might be a good time to look at refinancing. We can analyze your specific situation, look into your mortgage, your penalty, your potential savings, what the new rate and all that is. And the goal is to see if we can give you that much needed breathing room in your monthly budget. So if you like to explore this option, reach out. We can run the numbers together and see if refinancing makes sense for you. So thank you for listening to the Asian Connection Mortgage Podcast. I'm John Lee again, and I'll talk to you in the next episode. Take care, guys.
Thank you for tuning in. If you enjoyed today's episode, please consider giving us a review and subscribing to our podcast on your favorite platform. Thank you for listening, and we'll see you next time on the Asian Connection Mortgage Podcast.